Mortgage rates. Those two words can send a chill down the spine of any homeowner, and they've been rising, and rising fast.
A housing affordability crisis is brewing
due to mortgage rate rises. Mortgage rates rises
from £350 a month to £1,100 a month.
Nearly £3,000 extra annually.
It's on a 2-year fixed rate mortgage has gone up from 5.98% on Friday to 6.01% this morning.
And we're not just talking about a slight uptick. No, this is a substantial increase, the kind that can crush your home ownership dream harder than the pressure of the deep sea.
Are we about to be hit by a mortgage time bomb?
I've said before I'm worried there's a ticking time bomb on mortgages, and that time bomb has now exploded.
Martin Lewis is never wrong, is he? His prediction about the mortgage market wasn't just spot on, it was eerily accurate. This isn't just a story about numbers and statistics. No, it's about people. It's about you and me and the millions of homeowners who are feeling the pinch. It's about the changes in landscape of home owning, the rising tide of interest rates, and the shrinking pool of mortgage products available.
It was about $790 per month, and it's up to $1,400, nearly $1,450 now.
Her mortgage used to cost her £700 a month. Now she'll have to pay over £1,300.
There's still some bits to do, work top. You pour your heart and soul into a home. It's not just a house. It's a home where my little boy is raised, where we create memories, we have a dog, we play games. And to then make the decision that, well, I might have to sell it. It's gut-wrenching.
Mortgage rates have skyrocketed. The average 2-year fixed deal has jumped from 5.33% to 5.86% in just a month. Or maybe you're lucky watching this in the future, relieved that everything's back to normal and you can't believe that we got through it. Back to now though, and things have got worse. The number of mortgage products available is shrinking. Projections indicate that up to 2.6 million homeowners may pay significantly more annually due to these rising interest rates. At the start of 2023, the Bank of England suggested homeowners on fixed-rate mortgages would face an annual average repayment increase of £3,000. For the average household, this would mean an increase from £750 to £1,000 per month for mortgage payments. Finance experts across the city are cautioning that a substantial shift or reset in the mortgage landscape is imminent. Predictions of a housing price crash are intensifying, with some estimates projecting a decrease in values of up to 20% over the next 2 years. This increase in interest rates is also slowing down the house building sector, causing it to reach its lowest level of activity since May 2020. But why is it like this, and how did it get so bad? Was it just the greedy corporations buying up all the houses? Did the government forget to build new houses? Was it Brexit? Or is it something else which we never even thought about? The crisis is having real-world problems. A survey by Dye and Durham found that 56% of mortgage holders said that the cost of living crisis is affecting their mental health due to rising inflation. Another survey found that 30% of mortgage holders won't be able to make their mortgage repayments next year. And even worse, most responders said they'd only be able to pay their mortgage for 2 months if they lost their jobs, leading to mass repossessions in the UK property market. High interest rates have led to increased cost of living. People are reducing spending, dipping into savings, delaying major purchases, and people are even selling their belongings, and food banks are on the rise. And even if inflation decreases, the pressure on mortgages might be here to stay. I'm just going to stop with the facts for a minute to explain that I'm feeling this. I'm just as scared too. We bought our family home 4 years ago, and we only just got the mortgage that we needed for our house. We sat number crunching with a mortgage broker and finally managed to fix in at a fixed rate for 5 years at 2.16%. That percentage has more than doubled since we got our house. We're currently paying just under £1,000 a month, and come next year, it's going to hike up. Even though we're penny pinching, I feel like there's a huge cloud coming our way, and I genuinely don't know how we're going to afford everything. What can we say then for first-time buyers? What sort of impact is it going to have, and what advice can you give them?
Well, first-time buyers are in it for the long run. They need a home, and if they are renting, then the cost of renting may increase further. And the other thing I'm saying to clients as well is that there are many first-time buyers holding off for the minute or thinking of holding off. Now, we know what happens when everybody holds off, and in lockdown people had to hold off. There was a rush to the market when people were offering above the asking price, and there was a competitive bidding war going on. So if today's first-time buyers all hold off, that's what could happen again, isn't it? So I say if you need a family home and you're a first-time buyer, you need to look at it in the long position and get the best advice you can now.
Picture me and every woman in 1983 facing the crowd with a degree in my pocket, courtesy of a nationalised education system that didn't charge a dime. I'm earning a normal wage, and when the dust settles after tax and rent, I'm left with a tidy £12,300 disposable income. Stretching each penny until it squeals, I managed to save half, promising a 20% deposit on a modest house in just a couple of years. Then we fast forward to 2023. I remain that ordinary Brit, but the house that I want now has a price tag of £285,000. That degree I mentioned, well, it's got a price tag now around £9,250 a year, and the repayments on that come into effect when I earn just 25 grand. The job pays me 33 grand a year if I'm lucky, but after the tax man, the landlord, and the student loans have had their say, what's left could hardly be called pretty. And if I'm lucky, it'll be a decade before I can dream of a 20% deposit. And let me tell you, it's not just avocado toast and Starbucks that house in this pickle. In the span of 40 years, we've seen the average house price catapult by 14 times, from a humble 21 grand in 1983 to almost 295,000 in 2022. And now a house once cost just 3 times the salary, but now it's 9 times the bill. Friends were staring at the ugly mug of inequality. What happened? Let's step out of our world for a moment and take a journey through time to see how our ancestors got on. Did they struggle like we are, or was it a walk in the park for them? The UK housing market has evolved significantly since the end of World War II. In 1945, with a large part of the UK housing stock destroyed, the government focused on building new homes, predominantly council housing. This led to a boom in the public sector housing and a significant increase in home ownership. Do you know, back in 1950, you could buy a brand new house in the UK for around £1,891. Not bad, right? Well, even back then, it wasn't an easy feat, as the average weekly income was only £10. But those who managed to get on the property ladder, well, they're laughing now. The 70s was a roller coaster, a boom in home ownership, skyrocketed house prices, and the average house at the start of the decade was £4,057, a big leap from the 50s. But as we cruise into the 80s, the dream starts to crumble. Margaret Thatcher implemented the right to buy policy for council houses, and house prices shot up like never before. This allowed long-term council tenants to purchase their homes at discounted prices. The impact was huge. Millions of council houses were sold, reducing the public housing stock significantly and catapulting home ownership rates. Houses were no longer for living in, but instead assets for the wealthy. The deregulation of the financial markets in the 1980s and 1990s further fueled the growth of home ownership. Deregulation led to increased competitions among mortgage lenders, making mortgages more accessible and affordable to the average person. Also, the Building Societies Act of 1986 enabled building societies to compete directly with banks, pushing mortgage rates down. By 1990, even after a housing crash, an average home was going for a whopping £58,153. Guess what? The house price climb didn't stop there. The dawn of the new millennium saw another big leap, with average house prices nearly hitting 90 grand. Fast forward to 2005, and we saw an even bigger jump, with houses averaging around £156,236. The 2008 global financial crisis had a significant impact on the UK housing market. House prices plummeted and many homeowners found themselves in negative equity, so basically owing more on the mortgage than the property was worth. The Bank of England cut interest rates to historic lows to stimulate the economy, which further reduced the cost of borrowing and gradually stabilised the housing market. In an attempt to stimulate the housing market and make home ownership more accessible to first-time buyers, the UK government introduced a Help to Buy scheme in 2013, and the scheme offered equity loans and mortgage guarantees to buyers with small deposits. And in 2019, the average home cost £231,215, an astronomical rise from the 1950s. The pandemic led to an unexpected surge in housing demand as people sought larger living spaces due to remote work, and this, coupled with a continued reduction in interest rates, led to record high house prices. These steps highlight some key events and policies that have shaped the UK housing market over the last 75 years. While it's impossible to predict with certainty what the future holds, the ongoing impacts of Brexit, the end of the Help to Buy scheme, and potential changes in interest rates are likely to continue influencing the market. That's not all. I recently watched this really interesting video about the soaring house prices since the 90s, focusing on England between 1991 and 2016. It seems like the main issue isn't about supply and demand, as you might expect. Despite population growth, the number of homes actually increased more, and lifestyle changes haven't drastically affected the supply-demand balance either. Then there's empty homes and second homes to think about. But it seems a significant factor here is the buy-to-let market. It's doubled since 91, and that's definitely added pressure to the market. Interestingly, government schemes like Help to Buy, designed to boost building and support individuals, have actually contributed to keeping prices high by injecting more money into the market. The idea of building more homes as a solution hasn't quite worked out, since targets for new builds have been consistently missed. But the really key factor is the ultra-low interest rates, with cheap borrowing and poor returns on safe investments. More people have been pouring money into property. Some economists even argue that falling interest rates account for the entire rise in house prices. So while low interest rates are a huge factor, these other aspects also play their roles. There's growing concern about these rising prices, and the government has been introducing policies to tackle some of these factors. The fallout from the coronavirus pandemic and its impact on interest rates could mix things up even more, but it's unclear what that'll mean for house prices. But one thing a lot of people aren't talking about is that interest rates are actually coming back to normal levels. Take a look at this graph and you can see that interest rates were at an all-time low and they're simply creeping back. Historically, the base interest rate set by the Bank of England has been much higher, reaching over 15% in the late 1980s and early 1990s. My mum was actually explaining to me that when it shot up that high, it was a real struggle for us financially. She'd just given birth to twins, and then the rates went through the roof. Mortgage rates were also significantly higher during that time. And this means that while the recent increases are notable, they're not unprecedented. Let's look at the maths and try and break it down so it makes a bit more sense. An average house in the 90s at £57,901 with 15% with 25 years left to repay is £741.61p per calendar month. But an average house now at £300,000 over 25 years plus 15% would be £3,793.33. So if interest rates keep climbing, then housing will become completely unaffordable for the general population. Right, so would you say at the moment that mortgage rates are at an all-time high, or would you say it's just as high as a pre-financial crash?
Well, if we talk about the 2008 financial crash, of course, then the base rate before the crash was 5.75%, and the base rate is now 5%. And in August 2007, before the crash, the average 2-year fixed rate had fallen to 6.59%. So we're not quite at that level yet.
But what else is affecting the market? Well, let's go back to our trusty graphs. Here you can see that wages have gone up consistently. The average wage in the UK was 33 grand last year, and in 1999 it was just under 18,000. So our real issue is that inflation has gone up more and it's surpassed our wages. The inflation rate is in grey, and that's why it feels like we're financially drowning at times. So wages are growing at a record rate, unemployment's fallen, and there's been significant job growth in some sectors. However, rising prices continue to reduce the value of people's salaries. Cost of living increases are particularly big in areas like energy bills and food prices, which have seen, as you probably know, significant hikes. The impacts of Brexit and the COVID-19 pandemic on the UK housing market can be quite complex and, to be honest, multifaceted. And it's important to keep in mind that other factors, including government policy and general economic trends, have also played a significant role. Let's start with Brexit. The immediate aftermath saw a decrease in housing prices due to the uncertainty regarding the UK's future relationship with the EU. The Bank of England cut interest rates, and this could have contributed to an increase in housing demand and potentially prices as mortgages became more affordable. Next came COVID-19. Demand increased for properties with more space, both indoors and outdoors, and in less densely populated areas. So this contributed to the rise in house prices, particularly in suburban and rural areas. The Bank of England cut interest rates to a historic low to support the economy, making mortgages even more affordable and potentially stimulating demand for housing. But do you think we might have another hike before it's over?
I can't see that there is going to be a reduction imminently. There may well be another increase to try and kickstart and control inflation. So I think we have to live with the possibility, Janine, that yes, there might be another base rate increase.
If forecasts are to be believed, the Bank of England base rate is set to take one more hike up to 5.4% by the end of 2023 before slowly falling over the next few years to around 3.6%. And the reason it's been rising so much is to try and combat inflation, which, as we saw earlier, is rising faster than our wages. But the problem that many people are facing now is that lenders have been retracting the fixed rate deals in case the Bank of England raises the base rate again. Santander and HSBC have recently pulled out of their mortgage deals for new customers, leaving homeowners stranded. But I must stress that these are predictions and not certainties. It's totally out of our control, and all we can do is be across the economic forecasts and news. I read a speech that Andrew Bailey from the Bank of England gave at the London School of Economics, and it was this part that really stood out to me. He said words to this effect: "This increase in bank rate, a tool used by the Bank of England to manage inflation, impacts interest rates and yields, affecting the returns on savings and the cost of credit. It works through managing aggregate demand in the economy. When inflation is high, bank rate is increased to dampen demand and vice versa." So basically, what we can take from this in its simplest of terms is that interest rates are rising to combat the rise of inflation to try and help the country economically. Although, when this happens, it also brings the mortgage rates up with it. So will the government do anything about this rise in rates and inflation? Our Prime Minister, Rishi Sunak, pledged to halve inflation last May, which clearly isn't going very well. Inflation remains stubbornly high, with the real-world reduction in costs hardly felt by pretty much most people. While the decrease in inflation does contribute to Sunak's pledge, it does so in a very limited way. Now we've seen the rise and fall of mortgage rates over the decades, what can we do to get through these really tough financial times? Well, the only things that we can do are control our spending habits. We can budget, cut back, spend within our means, shop around to get the lowest prices, compare policy policies before we renew our insurance, and try and keep our food bills down where possible. If your fixed rate's going up soon, speak to a mortgage broker to make sure that you get the best deal that you possibly can. I want to leave you with some good news, and to be honest, it's given me a little bit of hope. Lenders representing an impressive 85% of the mortgage market have enthusiastically embraced the new mortgage charter designed to support homeowners. These lenders are launching a proactive communications campaign to make sure that borrowers are well informed about what to expect when they reach out to the lender. This is how it works. The charter brings some fantastic benefits for borrowers, including the option to switch to interest-only payments for 6 months or extend their mortgage term to reduce monthly payments. What's more, homeowners have the flexibility to revert to their original term within 6 months simply by contacting the lender. Customers approaching the end of a fixed rate deal will now have the opportunity to secure a new deal up to 6 months in advance, with a host of lenders including Barclays, NatWest, Lloyds, Nationwide, HSBC and Santander fully on board. This gives us all a bit of breathing space. This isn't the first time mortgage rates have risen abruptly and the country has financially suffered. It may be an unsettling time, but we'll get through it, and let's hope that we see a completely different picture by the end of 2024.